Commodities are in focus. Oil prices rebound after falling for over 3 years because of a reduction in U.S. stockpiles. We are being joined by Mark Keenan, the head of Commodities Research Asia at Societe Generale. He's joining us to make sense of the global commodity trade as well. Mark, thank you very much for joining us. First up, what is the sense on oil? Are we going to see further downticks? It seems to have been arrested only for the moment.
Yes, good morning. Certainly the oil market is as far as we're concerned, broadly range-bound at the moment. But within that range, behavior is certainly very volatile. The dynamics setting the sort of floor and the ceiling in prices at the moment are linked to, number one, on the bullish side, of course, the OPEC cuts and the non-OPEC cuts that we've had since the end of last year, putting a floor in prices. And then on the bearish side, of course, we have ever-increasing stories and reports of shale production coming back into the market. And as the market grapples with these dynamics, so the price of oil responds accordingly and is very volatile as a result of that. We also have, on the 25th of May, we have the next OPEC meeting that will no doubt contribute further to the volatility in the market. But our view and the general view in the market is that the cuts are certainly rolled over into the second half of the year. Okay. So in terms of direction, our view is higher prices towards Q4 of this year. For example, WTI we see averaging $60.50 in Q4 and Brent $62.50. And the challenge at the moment is really finding compelling entry points into the market from a long-only perspective to capture that uplift throughout the year. And so we focus very heavily at the moment on looking at things like positioning, speculative positioning, been very important over the last 8 weeks or so with these record positions in hedge funds, driving some quite swift liquidations as the market gets nervous, and very quickly these dips are bought. So our view is that you come into the market during these periods, weather the volatility and look for higher prices.
Okay. Mark, hi, good morning. Would the same view hold for base metals as well? We've seen quite a bit of correction there as well.
Absolutely. To a large extent with base metals, specifically zinc and specifically copper, where we see higher prices for the rest of this year. We see copper, for example, up to $6,300 a ton by Q4, and zinc up to $3,150. So some meaningful gains from current levels. Perhaps some of the metals like aluminium are still overdone. Remember that we had a very strong performance in the industrial metal complex at the end of last year and the beginning of this year following the election of President Trump and the already positive demand dynamics out of China. So with those huge gains, some 70% zinc was up in 2016. The market is naturally a bit cautious and there's been some retracement, but still, considering that, we still see value in going long these metals, copper and zinc specifically, with a view of higher prices into Q4.
Do you see value in going long in gold as well? Because there was a sentiment, knee-jerk reaction on the upside after geopolitical tensions resurfaced. But at this $1,280 per ounce, are you seeing any genuine demand or genuine buying in gold?
Well, that's a particularly interesting question. I mean, if we remove everything to do with safe haven and sort of geopolitical risk hedging from the gold market, our core view is that gold moves lower down to 1,125 or so, average that region in Q4 of this year. And that's driven by, lackluster physical demand both in China and India, and of course a rising dollar and rising rate outlook in the US. But, and very importantly, we've had 72 tons of inflows into the largest gold ETFs year to date. This is all safe haven appeal, and that is offsetting much of the supply-demand weakness, as it were. And people and clients, we see are really looking at gold at the moment as a hedge, an effective hedge, potentially against the landscape of elections that we have across Europe this year, most recently with the UK declaring election on the 8th, increasingly belligerent rhetoric between Trump and North Korea, Turkey to a certain extent. So there's certainly many supportive factors contributing to gold's stability at these levels. So from a portfolio perspective, from a safe haven appeal, and exposure to gold is certainly prudent. But we need to be mindful of the weakness in the physical demand on the ground level.
All right, Mark Keenan, it was a pleasure listening to you. Thank you very much for putting in perspective what's a very important fundamental cue for markets for 2017.